Hey guys, how you doing? Louis Giannis here. Today we had a interesting day, and actually yesterday was even more important. We had we've been kind of in a slump. We've been watching the U.S. stock market and the international stock market kind of easing its way down and not really rising like it was, and people were kind of getting spoiled watching the market rise. And as we came down recently, we had what I would consider to be an important technical sign of a bull bottom. In other words, we probably hit a short-term bottom. And the reason why I think that that's probably the case is as we came down, we had the breadth was getting worse and worse, meaning there was a lot of stocks that were not participating in the upward movement in the market. It was getting narrow and narrower and narrower. And as that happened, we kind of peaked and came down. And when we came down, we had a big uh, uh, reversal day, what's called an outside day, where the market opened lower and then rallied to the highs of the day, and it bounced off of key moving averages, and we saw really strong breadth on that bottom. So typically, when that happens, that is a sign of a rally. It doesn't really necessarily tell you how long the rally is going to last, but it does tell you that there's probably going to be continued rally. And the good news was today that we saw follow through in that price action, and we saw a lot of stocks do well. I was just looking at our portfolio, like the way we're positioned right now for a growth portfolio. I have my personal money, or some of my personal money, in kind of a growth strategy. We're about 44% in US equities and 13% or so in international stocks. We see international stocks being more attractive because their valuations are stronger. There's a chance that they could have a bigger relative pickup in attractiveness from a technical perspective. And we saw that today. We saw that the international markets were performing better than the US markets. In that growth strategy, we have about 18.87% in bonds. We're not, the thing about bonds is they're kind of a diversifier. The bond market in general, it doesn't look attractive, but we want to have some cushion right now in a growth portfolio. So, and I want to talk a little bit about these percentages and how they mean something, but in a way they don't mean something, because I want to explain that. But I'm talking about the percentage of the portfolio, and we're pretty heavy in cash right now. So we have a lot of cash for another reason. I want to explain that, why we have so much cash. And we also have some gold and some Bitcoin. We had a big day in Bitcoin. It was up 8% or so. And we have some agricultural commodities, things like that. But I want to explain why percentages of capital, like the percentage of your portfolio in these different asset classes, can be a little bit misleading. And it doesn't really tell you completely about your return profile or your risk profile. And the main reason has to do with volatility, because we have right now in our growth portfolio quite a bit of cash in those accounts, but the volatility and the participation in the market is actually slightly above the market risk level, and or volatility level, I should say. So we look at the daily moves in the markets, and if you look at the statistics of our blended portfolio, our projections are that we have about just a tiny bit more volatility, daily volatility, than the market. And the reason why we can do that with not being fully invested, is because the holdings that we have a little more volatility than the market itself. So one of the things that we do that's really, really important is we look at the volatility of the instruments. We look at the correlation of these instruments, these stocks, and we look at the attractiveness. We look at it from three different dimensions. How attractive is the stock? How do the stocks interact with the other stocks? How many overlapping fundamentals they have? Because if all the stocks have the same type of fundamental drivers, then they'll tend to move up and down together, which increases the risk. We like to have a diversification between those drivers. So that, combined with the volatility and the opportunity that we see in them, that will tell us, like, that gives us the guidance on what we do with our process on how much to invest in a stock. So anyhow, so we're able to get the participation without being fully invested and being on our risk target. Everything we do is designed to we seek to maximize our profit for the amount of risk that we take. So in our clients, we have clients that are really, really conservative. We have clients that are very, very aggressive. So we split them in five basic risk profiles, and there's tax management and other preferences there. But my point is that the percentages that you have in your portfolio don't necessarily mean how risky your portfolio is. You could have a portfolio that is fully invested and all of your positions are low volatility, high dividend paying stocks with very stable cash flows, and you will have less risk than the overall market. Or you could have more attractive stocks that are more volatile and have a lot of cash, and then you would still have the same or even less than the market risk. So, and then also the diversification there. So some of the bond market, the bonds are very interesting right now. We're doing kind of a barbell approach on the bonds because the bond market doesn't have a ton of attractiveness on the yields across the board. And what has been outperforming has been the emerging market bonds, the high yield bonds. So we're really looking to invest in bonds that have the ability to give you a reasonable interest rate and that you're not taking too much risk. So we're shorter on the yield curve. And then we also have some inflation protected bonds because we want to be in a position where if inflation rises, we want to be able to take advantage of that. So I think a lot of people I think most people don't even know what the heck they have in their portfolio, to be honest with you. But anyhow, so right now in the bond area, we're relatively light on the bonds. So we'd rather have a little bit of dry powder, but we're looking to deploy that dry powder. I think we've had probably a short-term bottom in the market, and we're probably heading higher from here. It would seem that way. We are bumping up against some seasonality that's coming up. Normally, September, October, we have some declines in the market, and people come back from vacation. Sometimes there's some selling activity that happens, so that wouldn't surprise me. But I think between now and then, maybe we'll have a little bit of firmness. One of the things that kind of came to my attention, I was thinking about, was the fact that we are basically heading into midterm elections. So that I think the Fed is likely, given the people that are on in the Fed who are making the decisions and their kind of their political leanings, it's likely that they won't tighten as fast as some people think they will. They probably will keep things relatively loose into the election. So I'm not really anticipating that much going on there. The other big risk that we see is this whole the virus concerns that are happening, the new variations. I know that it's a big deal. It's not something that you want to take lightly because it is very contagious, as I understand it. And I've seen anecdotal evidence with individual people that you could have COVID already, have had it already, get it again, and then and it could be pretty brutal. So even for young, healthy people. So I do think that there's some risk out there that we can have a rapid expansion. For the most part, I think the common wisdom right now is that, hey, look, people aren't, there's not, the hospitals aren't full and all of that. So that's probably going to keep the market relatively strong. I think the market is kind of looking through that right now. There's a little bit of jitters here and there, a lot of talk about it for sure, a lot of talk about the Fed tapering, but I don't see the market actually pricing that fully. So that's something to consider. Right now, the market is kind of in catch-up phase. The market priced in and anticipated rising earnings, and as the stock market moved up, and now we're starting to get those rises in earnings. We're starting to get the strong numbers, and you can look at the GDP numbers and the earnings numbers, and they're pretty strong. So we still have earnings coming in. And but it's really more of a catch-up game because given where interest rates are now and the earnings growth rates right now, we're kind of just catching up to where we were, and we may even be a little bit ahead of ourselves. But there's enough tailwind. There's nowhere to go really. So equities are the thing. So when I look at this and say, okay, well, even for an income investor, if I want to generate income right now and I'm looking at the bond market, that's not a good idea. So I can get a very low rate with a long dated instrument with a lot of risk in it, or I could buy a high quality stock that has a growth rate of 6, 7, 8, 9% in earnings that's sustainable and a low payout ratio, maybe paying a dividend of 2.5%, 3%. And my total return is going to be higher, most likely in all probability, than going to the fixed income market. So there's still that. And I think that there may be even more emphasis on that coming up. And so, there are little areas to be looking at. I'm not a big fan of owning the indexes. I think, as you know, you probably know, I like to have more active, but I do think there's still a lot of opportunities with these stocks that can pay 2.5, 3% dividend yields, could grow 7, 8, 9%, and your total return is going to be much better than owning fixed income. So even conservative investors who are looking for income, a right selected diversified portfolio with those types of stocks, likely to give you a better outcome, especially for conservative investors. But I do think we probably have had a short-term bottom in the market. We saw an outside day, market went down strong and then closed up very high on the highs, right, after a decline. The breath was very strong after a period of decline, and we had a follow through. So, and many of the stocks that we have had good days. You saw Bitcoin even recover. Bitcoin's up 8.37. Looking at our growth portfolio, Capital One is up 3.31. Marathon Petroleum's up 3.76. Our agricultural commodities, we have a little bit there, 1.5%. Little company we own, Blink Charging, is up 6.48% today. NVIDIA, one of our holdings, 4.29% up. Lam Research up 4.97. Nice day after a day that was a snapback yesterday. So I think, all the probabilities are that we're probably in a short-term uptrend, and that we may run into a little bit of trouble or a little bit of volatility as we get into that seasonality in October, September timeframe. People come back from vacation. So, and that will probably lead to some buying opportunities. So if you're in the market, that's what I'm thinking right now. Hope you guys have a great day. Thought I'd give you a quick update. Take care. Bye.